Good morning and welcome to our live webinar, Regulator Red Flags, Common Broker-Dealer Financial Statement Errors, hosted by PKF O'Connor Davies. All attendees are in listen mode only. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's call. We've taken a screenshot of the attendee interface and you should see something that looks like this on your own computer desktops. You will have the opportunity to submit text questions to today's presenters by typing your questions into the question pane of your control panel. You may send in your questions at any time during the webcast. We have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent post-event. This webinar is offering 1 CPE credit, and you will need to respond to 3 polling questions to receive credit. If you are having difficulty responding to a question, it is recommended that you come out of full screen mode to respond. CPE certificates will be issued within 8 to 10 days via email. PowerPoint slides and a recording of today's webinar will be made available to you via email a few hours after the event. At the end of the webinar, we do have a very short survey which will be prompted, and your response is greatly appreciated. I'd like to introduce today's presenters and speakers. Victor Pena, partner, broker-dealer practice leader with PKF O'Connor Davies. Harley Aronoff, partner and PCAOB quality assurance leader. Rachel DiDio, partner with PKF O'Connor Davies, and Kevin Keane Jr., partner as well with PKF O'Connor Davies. And now I'd like to turn it over to Vic Pena. Vic?
Thank you, Sandy. Good morning and happy Wednesday, everyone. We are in early February, so it's audit season. We hope that you are going through a very smooth audit, or better yet, have your audit completed. Operating in such a highly regulated environment can present various challenges for broker-dealers. It's not a matter of if, but rather when will the regulators come knocking at your door. There are things that give regulators a window to potential red flags. One of those things are a broker-dealer's annual report. The broker-dealer's team here at PKF O'Connor Davies has a dynamic mix of Wall Street, public accounting, and regulatory experience. Some of my partners whom you'll meet today have a combined 15 years of experience at the PCAOB. Our goal is that after today's presentation, you are better equipped to review your annual report to identify those red flags that may trigger unwanted attention from your regulators. My name is Vic Pena. I'm the broker-dealer practice leader here at PKF O'Connor Davies. Welcome to today's webinar. We are very excited to have you all join today's discussion on regulator red flags, common financial statement errors. This will be the first event of our broker-dealer value series for the year. So let's get started and go over today's agenda. Today's presentation will be broken down into 2 major categories. First, we'll go over regulatory considerations, where we will cover important topics such as the supporting schedules for net capital, reserve requirements, possession and control, as well as the exemption and compliance report. And second, we'll discuss GAAP considerations, where we will tackle some of the key financial statement preparation and disclosure findings by regulators, such as going concern considerations, revenue recognition, and lease disclosures. We encourage you to use the chat box in the question. If you have any questions, we will try our best to address them time permitting. But as Sandy said, if we don't have an opportunity to get to them, do not worry, we will reach out to you and make ourselves available. Also, if there are topics you would like to see covered in the future, please do let us know and drop those comments in the chat box. We welcome the opportunity to discuss those with you. So without further ado, I'll turn it over to my partner and former PCAOB inspector, Rachel DiDio. Rachel?
Thanks, Vic. Hi, everyone. I'm Rachel DiDio, and as Vic mentioned, I spent 7 years at the PCAOB prior to joining PKF O'Connor Davies. During that time, I inspected broker-dealers of all shapes and sizes. I'm excited to be here today with my colleagues presenting on some of the common financial statement errors a regulator can glean just from reading your financial statements. And with that, I'll start with net capital. Perfect. So first, I'll touch on haircuts. Often a regulator can get a pretty good estimate of what your haircut should be based on your financial statement disclosures. It's important to make sure that if you have an investment or foreign currency, you've included the haircuts in your computation and calculated them pursuant to the rule. It's also important to make sure that if you have haircuts in your computation, you've included the relevant financial statement disclosures.
Rachel, a lot of broker-dealers use internal or external software or tools to calculate their haircuts. Do any regulators have any concerns over these tools to compute haircuts as part of the net capital computation process?
Good question, Vic. Ultimately, the regulators don't have a concern with using internal or external tools or software. However, garbage in equals garbage out. So it's critical that you understand the inputs into your calculation, credit ratings, maturity dates, marketability, et cetera, to pay tribute to my former employer and use one of their consistent findings. How did you test the completeness and accuracy of the report?
Thanks for that, Rachel. Any special insights related to non-allowable assets? What are some of the biggest challenges here for broker-dealers?
So when it comes to non-allowable assets, each broker-dealer's facts and circumstances may be different, and the guidance and interpretations for the section titled Assets Not Readily Convertible into Cash is approximately 50 pages. So you see having a comprehensive understanding of all the different circumstances as one of the biggest challenges. So given this is only an hour, we don't have time to review all 50 pages in detail. In fact, we barely have time to scratch the surface of allowable versus non-allowable on today's webinar. That being said, a good place to start is going to be asking yourself, is my asset readily convertible to cash? For example, if commissions or management fees have been outstanding over 30 days, they're not allowable. Any unsecured receivables would not be allowable, PP&E non-allowable. Another important consideration, which I think is often overlooked, is whether the broker-dealer has possession or control of the asset. So this is specifically mentioned regarding collateral for receivables and reverse repurchase agreements. If the broker-dealer does not have possession or control, the asset is not allowable.
Thank you, Rachel. That's a lot to consider. One other point I did want to mention before you move on to minimum net capital is that broker-dealers often have intercompany assets transactions with affiliates. The net capital impact of these transactions have their own nuances to consider. So broker-dealers should consider and consult. They should be very familiarized with those rules. Also, we often see broker-dealers netting receivables and payables, relying on the respective interpretation. However, doing so without the required agreements. Substance over form arguments will not get you over the hump with the regulator here.
Good point. Thanks for bringing that up, Vic.
No problem. Why don't we move on to minimum net capital?
Sure. Based on the nature of your operations, as disclosed in your financial statements, a regulator is going to do a sense check to compare the minimum net capital requirement you're reporting. Your minimum net capital requirement should be consistent with your current or planned future operations or risks. For example, if you disclose that you offer a commissions recapture rebate program, a regulator would expect that your minimum net capital requirement is at least $250,000.
But have you ever seen instances where a broker-dealer used the incorrect minimum net capital? Is that even possible?
So I have. You're probably wondering, how does a broker-dealer report the incorrect minimum net capital? So typically when I've seen this occur, it's because the broker-dealer's operations have changed over time. However, they continue to use the minimum net capital per their original FINRA membership agreement.
Good to know. The key takeaway here is that if your operations changed over time and now include activities with a higher minimum net capital requirement, this needs to be evaluated. Moving on, it looks like withdrawals are next on the list. What do we want to focus on here, Rachel?
Yeah, thanks, Vic. I'll touch on this pretty quickly. I just wanted to highlight that 15C31, it requires restrictions on withdrawals and also requires written notice if certain thresholds are exceeded. So basically, if you're considering an equity withdrawal, make sure you've consulted Section E of the rule. And then the next item on the list is the focus reconciliation. So while we've been focused on 15C31, Just wanted to remind everybody that it's actually 17A5 that requires the broker-dealer to include a reconciliation of any material differences from the computation in the financial statements to the most recent focus filing. And again, it's key here to note that even if there are not material reconciling items, a statement indicating as such must be included in the financial statements.
Thanks, Rachel. Before we move on to the next topic, any other net capital insights you wanted to share with our audience?
Yes, thanks, Vic. So I did want to share a few other pointers that I thought might be helpful that a regulator may or may not be able to identify from the financial statements alone. The first is related to the deposit with clearing organizations. So it's important to remember, while this is often allowable, there are a few requirements to keep in mind. And this is basically that there needs to be in the written agreement, permit the return of the deposit within 30 calendar days after cancellation, state that the deposit does not represent ownership interest in the clearing broker-dealer, and include a termination penalty clause. So I have actually seen instances where an introducing broker-dealer and the clearing broker have had a long-standing relationship and they never modified their clearing agreement to include the required language, which hence meant this was then non-allowable. The second thing I just wanted to touch on is the required fidelity bond coverage. So again, all broker-dealers are required to maintain this and at specified levels of coverage. This is often something reviewed by regulators as part of their examination. The amounts can change based on the broker-dealer operations. So I've actually seen instances where the required coverage wasn't maintained and a deduction was required. And then the last thing I just wanted to touch on is just to remind everybody that you need to take charges if needed based on the results of your quarterly security count.
Thanks again for those insights, Rachel. Next, we'll walk through a polling question before I turn it over to my partner, Harley Aronoff, who is going to touch on the reserve computation. The minimum net capital for an introducing broker-dealer is always $5,000. A, true, or B, false? I'll give a couple seconds for people to answer. I know you're interested in insights and also a little bit of CPE here. A bit of a layup here. Of course, the answer is false. Not a broker-dealer's net capital, minimum net capital may be $5,000, but of course it won't always be $5,000. So it looks like most of the people got that right. So I'll turn it over to my partner, Harley Aronoff, to discuss reserve computation.
Oh, thanks, Vic. Hi, everyone. I'm Harley Aronoff, and sorry we're having a little technical issue with my camera, but I'm sure that that's actually a positive for most of you. You don't need to see my face. But anyhow, I worked alongside my colleague Rachel DiDio for about 8 years at the PCAOB, and as always, she's pretty humble. Yeah, we were both inspectors in the broker-dealer inspection group, but we were also technical experts on the broker-dealer inspection group's technical review committee. So, as part of that technical review committee, Rachel and I really learned everything we ever wanted to know about the PCAOB, but more importantly, about their audit standards and just exactly what the PCAOB and the other regulators expect from the broker-dealer and from their auditors. So now let's discuss the supplemental schedule that's required to be included in the audited financial report with respect to the reserve computation. All right.
So Harley, from your experience at the PCAOB in public accounting and in industry, what would you say is the #1 issue with the supplemental schedule for the reserve computation?
It's interesting because it seems like the most common issue seems to be a missing reconciliation, right? So we all know and we all see, and seems to rarely get missed, that the net capital supplemental schedule requires the reconciliation if there are any material differences between that computation in the supplemental schedule and the most recently filed focus. The same requirements exist for the reserve schedule, but for some reason it seems to be frequently missed.
Got it. With respect to the schedule for reserve computation, is there any low-hanging fruit type matters that are easy to avoid that you'd like to share with our audience?
Yeah, definitely. So clerical errors seems to be a big issue. So such as having the incorrect date on the deposit that is made to meet the reserve requirement, or actual errors, actually making the deposit on the date that is past the deadline, right? So ultimately, Rule 15C33, Section E3 states that the deposit should not be made later than 1 hour after the opening of banking business on the second business day following the computation.
That's right. So Harley, it often feels like the net capital schedule gets all the attention, it gets all the love, but given your regulator lens, how closely do the regulators look at this supplemental schedule?
Yeah, I'm glad you asked because it's kind of interesting. What I saw was when the PCAOB first had jurisdiction over the audits of broker dealers, I guess starting around 2012, it seemed like the other regulators didn't necessarily spend a lot of time looking at the financials. They spent more time looking at the supplemental schedules, right? The net capital, the reserve, possession or control. But I think once the amendments to Rule 17A5 came about and the requirement changed from that old study of internal controls, whatever that meant, and changed to the compliance report and I should say, or the exemption report, depending on whether you claim an exemption from customer protection or not. Right. So I think at that point, the regulators really started to pay a lot more attention. I've heard a lot of broker dealers get calls from FINRA, from their coordinator, and ask questions. I've even heard a few say that they weren't going to accept the financial report because of things like we spoke about earlier, missing reconciliation on one of the schedules. So definitely something to keep in mind. They pay attention to it now.
Got it. Now let's discuss the supplemental schedule for possession or control. Can you briefly discuss a bit about the red flags related to the form and content of this supplemental schedule?
Yeah, absolutely. So, firstly, let's keep in mind that the nature of these customer protection-based supplemental schedules, it really makes it harder for the regulator or for anyone else to find red flags, right? So the net capital schedule is primarily derived from the balance sheet. So it's really pretty easy to make an analytical comparison and find anything that seems to be off. But with respect to the reserve computation and especially the possession or control schedule, right, mostly customer trial balance, makes it a little bit harder. But let me tell you a couple things that I think the regulators could glean and certainly do. With respect to the reserve computation, if all of a sudden the regulators start seeing that debits really start growing, they start wondering if, what's going on with the margin activity and, is that increased risk? So certainly something that they pay attention to. And, because of that, you should really be aware of it.
Thanks, Harley. That makes a lot of sense. The possession and control schedule is fairly straightforward and without as much detailed information as the other two supplemental schedules. With that said, in your experience, are there any other any operational pitfalls to avoid related to possession or control that many broker dealers may miss?
Yeah, for sure. So there's a couple of things. One is that Federal Reserve has requirements around marginable securities, and certain securities, typically let's call them penny stocks, right? They typically are non-marginable. They have no collateral value. So one thing to keep in mind is when a broker dealer is computing their excess margin calculation, if the securities that are non-marginable are given collateral value, it's really going to make a big mess out of the possession or control requirements. It's going to understate, potentially understate what needs to be locked up. The other thing that I think is something to be aware of is also at the excess margin calculation, when certain customers have both cash balances and margin balances in the same account, those balances should be netted prior to the excess margin calculation. And once again, if that isn't done, then the debits will tend to be overstated, as will the credits, but that's going to lead to a lower required lockup for securities. So similar problem, and it's actually a big problem. I don't think there's anything that the SEC is more concerned about than possession or control and customer protection.
Absolutely. Thank you, Harley. Those are definitely issues that broker-dealers need to be aware of and avoid. Now, why don't we shift gears and discuss the exemption and the compliance report? Rachel?
Thanks, Vic. So for the next few minutes, I'm going to touch on a few red flags related to the exemption report. However, prior to that, I'm going to start with a little background. So some of you may or may not know. When broker-dealers went to file their focus reports, many years ago, the system only had the capabilities to select one exemption. So this led many in the industry to select the K2 single I exemption as the default, which, as I'm sure you guessed it, then resulted in many broker-dealers only claiming K2 single I in their exemption report to be consistent. However, K2 single I is not a catch-all, and a broker-dealer should claim any and all exemptions, as well as footnote 74 when applicable. So the SEC actually updated its FAQ, which was originally issued in July of 2013, related to the amendments to the broker-dealer financial reporting rule in July of 2020. So I do know the slides aren't up, so we're having a little technical difficulties, but we'll distribute them after, and the link to that FAQ is included.
Thank you, Rachel. Clearly, all FAQs are important, but any thoughts on specific questions within the FAQs that broker-dealers should pay attention to?
Absolutely. So questions number 8 and 12 will be two of the questions that will provide more clarity on reporting the exemptions and footnote 74 in the exemption report and focus filings. So what I'll do now is, now that we know we must claim any and all exemptions as well as footnote 74, what types of things would a regulator look for? So let's start with K2 single I. So if you disclose in your financial statements that you maintain a special account for the exclusive benefits of customers, a regulator will expect to see K2 single I on your exemption report. Second, if you disclose that you clear transactions on a fully disclosed basis with a clearing firm, a regulator is going to expect to see K2 double I on your exemption report. And third, another one is, if you're described as a non-covered firm, a regulator would expect to see footnote 74. If you want to know more about what a non-covered firm is, you can actually go to question number 8 on the FAQ, and now you can see that link on your screen. But at a high level, this is a broker-dealer that has not held customer activities or funds and doesn't necessarily fit into one of those previous exemptions. So the other thing that's important here is to remember it works both ways. So if you include certain exemptions or footnote 74 in your exemption report, well, the regulators are then going to go look into your financial statements and expect to see disclosures related to those revenue generating activities with your customers.
Thank you, Rachel. Before we move on, any other exemption report insights you'd like to share with us?
Yes, thanks, Vic. I wanted to quickly discuss prompt transmittal and reporting exceptions. So again, a regulator would not necessarily be able to identify these in your exemption report based on your financial statements. However, it's something they will look at if you are subject to an examination. So when it comes to prompt transmittal, make sure you can evidence that the funds were transmitted by noon of the next business day. If they were not, then this would be required to be reported as an exception. Listen, exceptions happen. It's not uncommon for a broker-dealer to miss a prompt transmittal for a variety of reasons, right? Maybe the employee opened the mail, received the checks, it got buried below paperwork, and they didn't see it until later the next day. Whatever the case may be, when something is impromptly transmitted, 1 check, 1,000 checks, 2 checks, it could be for $1 or a penny or $1 million. It doesn't matter. You should report it, as that's what the rule requires. As long as this isn't a common theme and you can support that you're rectifying the issue, this should satisfy the regulator. However, if this is a common theme and month over month or year over year, you have exceptions, the regulators will start to question whether you should actually be a carrying broker-dealer now and maintain minimum net capital of at least $250,000.
Thanks for that, Rachel. Wearing my auditor hat here, I did want to make a comment that the PCAOB standards require auditors to modify their opinion if they believe one or more assertions in the exemption report are not fairly stated. So what does this mean? If the auditor believes that the exemptions claimed are not complete or accurate, or exemptions occurred that are not disclosed, the auditor will have to issue a modified report. Basically, the exemption report and the audit report should be consistent. Otherwise, it's a red flag. So continuing on, we got to make sure we get our CP here. Why don't we walk through the next polling question? The following is not one of the financial responsibility rules covered in the compliance report. A, 15C31, the net capital rule. B, 15C33, customer protection rule. Regulation T, Federal Reserve Margin Rule. 17A3, D, 17A13, quarterly security count. And E, FINRA Rule 2340, the account statement rule. So we'll give you a few seconds to answer that. Hopefully everyone got this right. The correct answer is C, Regulation T, which govern cash accounts in the amount and credits that broker-dealers can extend to investors for the purchase of securities, and is not one of the financial responsibility rules covered in the compliance report. Now, let's pivot and take a few minutes and walk through and talk about the compliance report for those broker-dealers that do not claim an exemption from the customer protection rule. Harley, the compliance report seems pretty straightforward. What are some of the common issues here?
Well, first off, let's make sure we're all on the same page. So in the compliance report, management has to make 5 assertions. And, you know, the assertions are that management has internal controls over compliance, that those internal controls over compliance were effective as of the end of the most recent fiscal year, that the internal controls over compliance were effective throughout the fiscal year. And the broker-dealer also has to assert that they were in compliance at the end of the year with the reserve computation and the net capital rule with respect to those computations. And then lastly, the broker-dealer has to assert that the information that was used to determine that the broker-dealer was in compliance with the respective computations, that it was actually derived from the books and records of the broker-dealer, right? So bottom line is you got to get that right? Those assertions are mandated by the SEC in Rule 17A5, and you have to get that right. The next thing I would say is, you know, I've seen this before where management has their compliance report and they assert that internal controls over compliance are operating effectively. And then the auditor issues a qualified opinion saying, whoa, not so fast. Those controls over compliance are not operating effectively, right? Or you were not in compliance at year end. That makes no sense to me. Really, the auditor and the broker-dealer should be on the same page. It's always going to be better for the broker-dealer to say, we did develop internal controls over compliance that are effective, with the exception of, and then list those exceptions, so that the auditor could issue an unqualified opinion and say, yeah, we agree, as opposed to what I would think would be a really big red flag, which is, once again, obtaining a qualified opinion from the auditor. The next thing I think is worth talking about are some misconceptions of some very important definitions. So first off, let's talk about what exactly is the definition of material weakness in internal controls over compliance. So one of the big misconceptions is whether or not there was an error. And the conclusion's often mistakenly, there was no error, therefore controls over compliance are operating effectively. And that's just not the case, right? So material weakness in internal controls over compliance, there's no Monday morning quarterbacking allowed, right? So we have to determine, is there a reasonable possibility that non-compliance with the computations and material non-compliance with the other financial responsibility rules doesn't exist, right? So we need to keep that in mind. The next thing, definition-wise, non-compliance. So I mentioned a moment ago, non-compliance with the computations and material non-compliance with the other financial responsibility rules. So ultimately what that means, non-compliance with the computations, you either have excess above the required minimum or you don't. And of course, with the net capital, you also have to keep in mind early warning, right? The 120% above the required minimum. So, that's important to know, because with the other financial responsibility rules, the account statement rule, the quarterly security count, and the possession or control aspect of customer protection, there we're talking about material non-compliance. Okay, so keep in mind, material non-compliance, it's really a judgment call, right? So if one account statement that was required to be delivered to a customer wasn't delivered, maybe it was material, maybe not, right? It depends, and that needs to be evaluated. But management needs to be aware that, once again, we're talking about material non-compliance for those three financial responsibility rules, but non-compliance, exhausting your excess for the computations. So hopefully that makes sense.
Yeah, it does, Harley. Thank you. The misconception of material weaknesses in internal control over compliance certainly trips many in the industry. Clearly, there's a lot of regulatory matters related to the compliance report for broker-dealers that can be easily avoided. Similar to what I mentioned before for the auditor's report on the exemption report, basically the compliance report and audit report should be consistent. Otherwise, this is a big red flag. So we have touched on the common red flags for the regulatory reporting side. We will now pivot to GAAP considerations with my colleague, Kevin Keane, Jr.
My name is Kevin Keane, Jr., and I have over 10 years of experience in the broker-dealer industry. My colleagues touched on the common errors with regards to the regulatory reporting included in the financial statements. I'll be discussing key GAAP considerations for broker-dealers, starting with going concern.
Kevin, what would regulators expect to see in the financial statements if they believe that there was doubt about an entity's ability to continue as a going concern?
So broker-dealers need to consider the need for disclosures in the financial statements if there's substantial doubt about an entity's ability to continue as a going concern, including management's plans to alleviate the doubt. So the regulators can get a good idea of the financial position of a broker-dealer from reading the financial statements and identifying certain red flags, such as negative operating cash flows and net loss. This might raise substantial doubt about an entity's ability to continue as a going concern, and disclosure may be required.
Got it, Kevin. Are there any instances where a broker-dealer may rely on a third party, such as a parent company, for financial support? Would this cause any going concern issues?
Yes, broker-dealers' management plans to overcome the adverse effects of the conditions or events that indicated substantial doubt can include continued support from other parties. However, the auditors will need to consider the intent and ability of the other parties to provide financial support to the broker-dealer.
Got it. Is it the auditor's responsibility to identify going concern considerations and disclosures to include in the financial statements?
No, the financial statements, including the disclosures, are the responsibility of management. Management is required to detail its plan to alleviate the conditions that gave rise to substantial doubt about an entity's ability to continue as a going concern. The auditors conclude on management's plan and whether it alleviates the concerns. The broker-dealer and auditors must maintain independence throughout the audit. The independence rules that govern broker-dealers are very stringent.
Got it. Thank you, Kevin. Why don't we touch upon the revenue recognition, as this continues to be a common area where the regulators see deficiencies. Can you discuss why this continues to be such a hot topic and area of focus for regulators?
Yes, Vic. Another big area of focus for the regulators is revenues and the related disclosures. This is a common area where regulators see incomplete or missing disclosures as it relates to ASC 606, revenue from contract with customers. Revenues continue to be a hot topic for the regulators for both the broker-dealers and for the accounting firms.
What are some of the common revenue disclosures that can raise red flags if they are not included in the financial statements?
So if a broker-dealer is earning revenues from multiple streams, ASC 606 requires the revenues to either be disaggregated on the face of the statements, and if not on the statement, then this must be disclosed in the notes of the financial statements. For instance, M&A broker-dealers typically earn revenues via retainer and success fees. The broker-dealers are required to disaggregate the revenue earned through retainer fees and for success fees either on the statement of operations or disclosed in the notes to the financial statements. These types of revenue streams typically are earned over time, retainer fees, and at a point in time, success fees.
Got it. And with ASC 606, the accounting for retainer fees and the recognition of these fees can cause headaches for broker dealers and their auditors. Do you have any advice for broker dealers with regards to retainer fees?
So retainer fees and success fees and the related performance obligations are typically spelled out in the contract. As a deal is progressing, no one knows better about the work performed than the broker dealer and its representatives responsible for the respective deals. Tracking the work performed and the services provided to satisfy the performance obligations related to retainer fees can make the broker dealers and their auditors' lives easier. Ultimately, for these fees to be recognized, the broker dealer must show that the performance obligation has been satisfied. Another approach could be to modify the contracts entered into to explicitly call out the distinct performance obligations related to retainer fees and the success fees.
Got it. Thank you, Kevin. We could probably have a whole discussion just related to that. Any other considerations that broker dealers should be aware of as it relates to ASC 606 before we move on?
Under the revenue recognition standard, there's a 5-step model for revenue recognition. One of the steps requires an entity to allocate the transaction price, including the estimated standalone selling price, across the separate performance obligations. Broker dealers need to consider the terms of the contracts entered into when they're providing multiple services. The terms stipulated in the contract for the distinct services are not necessarily the right way to allocate the standalone selling price for the various services. An entity must consider whether there's evidence that is indicative of the standalone selling price, such as a contract entered into to provide one of the services offered. The contract that contains the single service and the price for this service would be indicative of the standalone selling price, regardless of the contract entered into to provide multiple services has a different price for that one service. This will ultimately drive the recognition of revenue. The revenue recognition rules and allocating the standalone selling price needs to be well thought out and documented by the broker dealer.
Thanks, Kevin. Good point there. Speaking of standards that have been implemented in the past few years, can you speak about the lease standard, ASC 842?
Sure. Since broker dealers are considered public companies, the lease standard was required to be adopted a few years ago. Under the lease standard, the lessee is now required to record long-term leases on the balance sheet. The previous lease accounting standard did not require this to be included on the face of the financial statements. An entity would disclose the minimum future payments associated with the leases. Lease recognition and measurement needs to be in conformity with the lease standard. It's important for broker dealers to be cognizant of the qualitative and quantitative disclosures required under ASC 842. The lease standard introduced complexities that entities need to be aware of in order to be compliant with the standard in terms of the recognition and measurement of leases. The standard also includes enhanced disclosure requirements for entities. The more extensive an entity's leasing activities, the more comprehensive the disclosures will be.
Thanks, Kevin. And I know that no one in the audience would say this, but what about those who would say that our auditors tell us the correct treatment for leases under the lease standard?
So again, there are strict independence rules, and the determination of the requirements of the lease standard are the responsibility of the broker dealer's management. Management is responsible for ensuring that the broker dealer is in compliance with the accounting standards, including the required disclosures.
Thanks, Kevin. Harley, why don't you walk us through our next polling question? Harley, you there?
I'm sorry about that, Vic. Sorry about that.
No worries.
So the polling question is a statement, actually. So the statement is, I could reach out to the following for expert advice on broker-dealer operational or compliance matters. And your choices are A, PCAOB, B, the SEC, C, FINRA, or D, PKF O'Connor's, or last one, I guess it could depend, but the bottom line is, I think it's hopefully clear to everybody that choice D, PKF O'Connor Davies, is the right answer. Asking the regulators for expert advice, yeah, talk about a red flag. Ask them for some advice, you'll probably hear about that pretty quickly. So hopefully everybody got that right, but kidding aside, we are always available for any questions, any way we can help out. So please feel free to reach out.
Thank you, team. Thank you, Harley. We do have some questions in the chat box. I've been monitoring them. I'd like us to take a little bit of time to answer some of them. Again, if we don't have an opportunity to get to all of them, please do not not worry, we'll make sure that we reach out after the fact. I'll start with a question that appears on the exemption report. Which exemption should a broker-dealer claim if the transactions with customers are mostly through a clearing firm, with only an immaterial amount directly from a mutual fund company? Rachel, you want to take on this one?
I do, Vic. This is one of my favorite questions, and I will probably sound like a broken record here, but I have to insert my plug for completeness and accuracy. So the question asks which exemption, which implies they may be looking for only one exemption. However, the answer to this specific question is going to be more than one. So the exemptions claimed, again, should describe all of the broker-dealer's revenue-generating activities resulting from its transactions with its customers. So if we start with the transactions with the clearing firm, assuming they're on a fully disclosed basis, you'd claim K2II. Now, for the fund transactions, even though they're immaterial, you'd still be required to claim the accurate exemption here. So if we assume the arrangement with the mutual fund is such that funds received by the broker-dealer get deposited into a special account for the exclusive benefit of customers, then the broker-dealer would also claim K2I. However, depending on the nature of the activity with the fund company, if the broker-dealer does not have a special account and would not receive funds from the customers, this could be footnote 74. And again, not to imply you can only have two exemptions claimed in footnote 74, you can actually claim all three. And we have seen broker-dealers that do. They operate pursuant to K2I, K2II, and footnote 74.
No, that's true. Not a cookie cutter approach for sure. So thank you for that. The next question relates to net capital. How do you know if a security is non-marketable, and how do you treat it for net capital purposes?
So I'll take this one as well, since I touched on net capital earlier. So a non-marketable security, defined by the rule as a security for which there is no ready market, as well as a security that can't be publicly offered or sold because of regulatory restrictions. So seems pretty straightforward that a non-marketable security is one for which there is no ready market. But I think the next question is probably great. So what is a ready market? This is also in the rule. It's defined as securities for which independent offers to buy and sell exist, such that you can find a reasonable independent price and you can expect payment and settlement. I paraphrased it, so there's a lot more to it in the rule, but I think you get the gist. But I touched on it earlier, and again, it's really important for a broker-dealer to know the inputs into its calculation. So I've seen this missed actually by a very large broker, market maker in penny stocks. Now, the stocks may have traded, but in small volumes and some not for months. Also, some of the stocks, the last price wasn't representative of an exit price, and that's because some of these companies were now delisted from trading. So clearly these securities were not marketable. However, they treated them as if they were actively listed securities because they could find a price for them. So clearly securities were not marketable. So now, once you know what's a non-marketable security, the next question is the treatment. So the good news is here, the treatment's easy. 100% charge. If it's non-marketable, 100% charge to net capital for the value of the non-marketable security. And it's actually going to be classified as a part of net capital before haircuts, so tentative net capital, rather than as a haircut.
Thanks, Rachel. The next question seems related to revenue. Kevin, perhaps you could take this one. Have you heard of broker-dealers changing the language in their contracts as a result of the revenue recognition accounting standard?
Definitely. Many old agreements were written well before the accounting standard was introduced. And it is common that the language in those old agreements is ambiguous or they don't mention anything about performance obligations. This makes it difficult to determine what the performance obligation is and how it can be satisfied in order to recognize revenue. I encourage broker-dealers and the legal counsel to draft contracts and agreements with customers that considers the requirements of ASC 606.
Yeah, it's a little bit of a, it might seem like a little bit of a heavy lift, but certainly you're going to get a lot of benefit Ultimately, most of the time you see those more of a template, if you will, that gets customized depending on the deal. So, if you do the heavy lift on the front end, you're probably going to save yourself a lot of headaches as you're going through your audit. So you'll be able to rinse and repeat, if you will. The next question relates to the reserve computation. Does the reserve account have to be titled a specific way? And are there other requirements related to the account?
Oh, Vic, I could take this one. I'm glad this was asked. The special reserve account, I've seen all kinds of different titling, but the bottom line is that recent amendments to the rules, 17A5 specifically, require that the special reserve account for the exclusive benefit of customers be titled exactly that, special reserve account for the exclusive benefit of the customers of the name of the broker dealer. And there also has to be a bank notification letter. And this is pretty critical. It's obviously not something in the financial statements, but if a regulator asks for it, the broker dealer better be able to provide it. So the bank notification letter is simply basically we call it a no lien letter, right? It's the bank, the legal language that's saying that account is protected in case of liquidation of the broker dealer. It's customer money and it belongs to customers. So the requirements are pretty strict. The bank notification letter has to be on bank stationery. It has to be executed by an authorized officer of the bank, and it has to include the exact language, which is shall be subject to no right, charge, security interest, lien, or claim of any kind in favor of the bank or any person claiming through the bank. So the last thing I'll say is I've seen that language say in favor of the bank and not say in favor of the bank or anyone else. And something that simple, something that little is a big deal. So hopefully that answers that question, Ben.
Yeah, no, it certainly does. As I mentioned before, some of these rules are very specific as to what language should be used. So you're not going to be able to make arguments of substance over form, even though intuitively they might make sense. You either have the right language or you don't. So sticking with 15C33, but switching gears to possession or control, there is a question on if a security can't be obtained to meet a stock deficit, to meet the possession or control requirements, or otherwise chilled, can the broker dealer ignore it going forward for possession and control purposes?
No, they actually can't. And there are a lot, like you said, there are a lot of times where security for one reason or another cannot be obtained. It could be chilled, many different reasons. And the bottom line is that the rules require that broker dealers make an ongoing good faith effort to resolve any security deficits into perpetuity. So, yeah, maybe there's a security that you'll never be able to obtain, but you have to make that ongoing good faith effort. So just keep that in mind.
Got it. Thank you, Harley. Now, we have a question related to the compliance report. Should a broker-dealer's compliance report assert that internal controls over compliance are not effective, even if the company determines that some of the internal controls over compliance are effective, but others are not?
Yeah, it's a really interesting question because, like I mentioned earlier, you want to be on the same page as the auditor. It really doesn't make a lot of sense to find yourself in a situation where the auditor disagrees with management's assertions in the compliance report. But there are also situations where some internal controls are effective and some aren't in certain areas, right? With respect to one or more of the financial responsibility rules. So just as an example, let's say that internal controls are effective with the exception of over net capital, then yes, the management should have a compliance report that states our internal controls over compliance were effective at year end and throughout the year, but then state with the exception of, and then they could state the net capital, the controls over net capital.
Got it. Thank you, Harley. There's one other question that seems to have come up. It says, what are our thoughts as to whether the regulators, i.e. FINRA, PCAOB, SEC, how much do we think that they are in communication?
I could touch on that. First off, I think there's a little known rule that the PCAOB has that everyone should really be aware of. It's publicly available. It's called Rule 4004. And the rule is very simple. It says that there are instances that through the inspection of the work papers of the audit, the PCAOB might become aware of certain matters, and they will have to communicate that to the SEC. Now, that rule doesn't state how, when, why exactly, but there is that rule. So certainly we could make the assumption with pretty good certainty that they do speak. And we got to keep that in mind, because the auditor and the broker dealer are often, for lack of a better way of putting it, married to each other, right? So if the auditor's not doing a good job and the PCAOB inspects them, the vendor is probably going to hear about it, and the broker dealer is probably going to be asking questions without even knowing where that stemmed from. And it works the other way around too, okay? But just keep that in mind.
Yeah. Harley, sorry, Rachel, anything you wanna, any other thoughts on that? That's a really good point you're making, Harley.
Yeah, the only thing I was going to touch on, and Harley mentioned the rule, right? It's not a secret. It's a publicly available rule for the PCAOB. But I'm sure if each of you think back, you probably won't be shocked that you would see an enforcement action maybe from one regulator, and either, shortly before or thereafter, you then see a similar enforcement action from the other regulator, right? One's going to be under auditing standards, one's going to be under the SEC rules and regulations. But again, it's important to keep in mind. So, sometimes we may talk about auditing rules and standards, and those will be applicable to the broker dealers as well, because again, the regulators, they have a relationship and they all talk.
Well, thank you. As I mentioned before, the annual report really gives a lot of insights to regulators as to raising red flags. So, not to be biased being an auditor, but sometimes your auditor might make comments on the financial statements that, sometimes you want to the extent that they make sense, and you want to embrace some of them too, because having the cleanest report really will keep you out of trouble. Will certainly not raise unnecessary red flags. So something to consider. So that brings us to the end of our presentation. I want to be respectful of people's time. Thank you, Kevin, Rachel, and Harley, for providing your insights, and thank you for everyone who joined us today. I will take a brief moment to give you some background on our firm, PKF O'Connor Davies. We are a national audit, tax, and advisory firm established in 1891. We are PCAOB and SEMA registered and have 1,500 professionals across 17 offices. In addition, we are the largest member firm in the PKF International Network, the 15th largest global accounting network in the world. Within our financial services and broker-dealer group, we have professionals with regulatory, Wall Street, brokerage, domestic and international Big Four public accounting and auditing experience. We look forward and are committed to providing insights throughout the year to the broker-dealer community. Please stay tuned for an upcoming event in late spring and early June, early summer. If there are any specific questions or matters that perhaps you would like clarity on, please don't be a stranger. Reach out to us. We welcome the opportunity to discuss those with you. Please remember to complete the short survey prompted at the close of this webinar. A recording of this webinar, as well as the PowerPoint slides, will be available to the attendees via email within the next few hours. And on behalf of our team and from everyone here at PKF O'Connor Davies, we thank you again and have a fantastic rest of your day.
Thanks, everyone. Appreciate it.
Thank you.
Thank you.
Thank you.